Good morning, everyone, and thanks for joining us. Today, we are joined by Tumi from 361 Asset Management and here to discuss the benefits of hedge funds. So I think, Tumi, firstly, thanks for joining us. And I think just to start off, if we can maybe start with a brief intro just into what exactly a hedge fund is and how it differs from your typical long-only unit trust portfolio.
Good morning, everyone, just a pleasure being with you guys this morning, just to discuss sort of the differences between your hedge fund versus sort of your long-only or unit trust. The first thing is just to explain the hedge fund tool set. So whereas your long-only or unit trust portfolios can only sort of invest in securities and get returns from your securities going up in value, your hedge fund has additional tool sets over and above that single tool set. So what your hedge fund will have in your portfolio is you have the ability to go long, which means to profit from securities going up. So you want to hold securities that you think over the long term will do well. You've also got shorts in your portfolio. And how we describe those shorts in your portfolio is if, for instance, we're worried about corporate governance, if you're worried about sort of the sector going forward, revenue growth, or any form of measures in this company, you have the ability to also include a short in your fund and actually profit from a downward decline in the security. So if the stock then were to, over time, over the next few months, go down, you can then take that and close that short position, and then it actually results in increased returns for your client. So the fact that you've actually got a portfolio that can make bets, it's called multi-directional bets, on actual securities either going up or securities going down in value. And then the additional tool set that I also want to mention even is just your derivatives, the ability to actually include derivatives in your portfolio. So a lot of people have been quite nervous in the hedge fund space of the use of these derivatives and what it means in terms of increased leverage or increased bets that a lot of these hedge fund managers are making. But for a lot of portfolios and a lot of the South African, specifically hedge fund portfolios, the use of derivatives can also sort of protect your portfolio. So we usually like to enter into what is called put option structures or derivatives that provide some form of insurance for your portfolio. So if the market goes down significantly, we actually don't see that impact hitting a lot of the hedge fund portfolios. We're able to protect some of the capital in your funds through the use of these derivative structures. Just to highlight, two of those.
Yeah, that's perfect. That portfolio, that tool set obviously adds a lot of value then in including these portfolios as part of your total portfolio. And maybe moving on from that, so what would you then say is the primary benefits from including these portfolios in clients' portfolios?
So the biggest benefit of including these is the fact that you've actually got significantly lower volatility in terms of a fund portfolio that forms part of your returns. So a lot of the time when people sort of are looking at their portfolios and managing the portfolios, particularly as people sort of increase in age, they get quite nervous of sort of being completely exposed to the market. If you were to include hedge funds in your portfolio, you can still get very good returns, but at a significantly lower volatility. And that volatility sort of indicates increased bets in terms of being highly exposed to the market, lowly exposed to the market. So it just shows sort of your correlation to the market. And if a lot of the clients want part of their portfolio to have uncorrelated returns to the market, it's usually a benefit to have these hedge funds form part of their portfolio. A big thing with hedge funds, because of that reduced volatility, is during periods of market stress or market uncertainty, when there's significant drawdowns in terms of index returns, where you can see your ALSI sort of dip by like 12%, what your hedge funds can do in your portfolio is limit those capital losses. So you're not seeing as significant losses in the hedge fund portfolios as you typically see in some of the long-only portfolios.
Okay, yes, that makes sense. And that's obviously what also drives us or makes it such a valuable alternative source of returns and kind of
100%.
portion of your portfolio. Maybe moving on, what we kind of the last question from me is what we often see from investors is that there's a lot of concerns around the regulations on these portfolios or the lack thereof. And we obviously know there's been a lot of changes over the past few years in terms of regulation. And then also the liquidity that we have in these portfolios. So can you maybe just touch on your view on that and your response to these type of concerns?
100%. So quite a lot of the hedge funds sort of that were running in the US of late that had actually closed down, quite a lot of the hedge fund managers were making outsized bets in terms of increasing the amount of leverage in their portfolios and sort of this impacting the shareholders of the clients. What we've seen is quite a lot of increased regulation surrounding the amount of leverage that a hedge fund is allowed to have in their portfolio. So if we look at the current regulations, it states that you have to have gross exposure of 200%. So you're not allowed being more than 200% invested versus the market. And a lot of the hedge funds, if you were to look at it, even though there's that regulation cap, a significant amount of the hedge funds are significantly even below that 200% leverage cap that is applied to a lot of the hedge funds. Besides that, there's a lot of increased transparency now in terms of the disclosure that is being made on what is included in terms of your portfolio. What are the longs? What are the shorts? What are the derivative positions? What types of bets are you making on the market? So with that increased transparency for clients are a lot more comfortable in terms of understanding sort of the net exposures, what's happening on the gross exposures, what's the positioning of the funds, what's the derivative, what's the amount of leverage in the funds. And all that increased transparency and disclosure, I think, has been beneficial for the entire hedge fund industry just to make a lot of the clients a lot more comfortable. Then what we've also had is we would have noted that there's a lot of more retail hedge fund platforms that have come up, funds that have come up on the platforms. And with the retail hedge funds, just in terms of liquidity, just to note, the qualified investor hedge funds that were managed at the time and the recent retail investor hedge funds, you are now seeing daily liquidity being provided on these retailer hedge funds, with a lot of the minimums also being reduced to give access to a lot of clients. So you mentioned, just to touch on liquidity, daily liquidity is provided, increased transparency, and there are caps on the amount of leverage in these portfolios.
Okay, perfect. So clearly a lot's been done in terms of regulation and kind of tackling a lot of the risks that were previously in these portfolios, and a lot better liquidity and transparency, as you said. Tumi, I want to thank you. Thanks to everyone for joining us. That's Tumi from 361 Asset Management. The 361 Retail Hedge Fund is a key holding in our recently launched Naviga multi-strategy hedge fund portfolio. The portfolio is available on various platforms, so please reach out to any of us at the Naviga team if you need more information on that portfolio.